Hello guys and welcome to another deep value video. Today taking an in-depth look at AMAT, Applied Materials Incorporated, an American corporation that supplies equipment, services, and software for the manufacture of semiconductor chips for electronics, flat panel displays for computers, smartphones, televisions, and solar products. The company also supplies equipment to produce coatings for flexible electronics, packaging, and other applications. So first of all, let's start with their business metrics. As always, we'll first look at return on invested capital, which is 26%. It is really good. Their return on equity is almost 48%. Their current ratio is 2.51. So what does this mean? Well, it means that their short-term liquidity is extremely good. Their return on tangible assets is 23.6%, also a really good metric. And we can see that the stock price has decreased over the past year and they currently have a price to earnings of 21.4 and they're trading at a free cash flow yield of 4.9%, which is okay, I guess. Well below the market average, but compared to the historical averages, it's slightly above. I mean, the historical averages of the market, of course, not of the company. Now, first of all, to find the real value, we'll first do a grams variation. I put in the 2025 estimated EPS, which is $9.36, and using Graham's revised formula, we get an intrinsic value of $219.6. Moving on to the cash flow model, discounted cash flow model, sorry, we can see that their average free cash flow growth rate over the past 10 years has been 32%. I inputted a 7.5% growth rate for the next 9 years with a 2% perpetual growth rate and an 8% discount rate. I think these are okay assumptions. I don't think I've gone too far. I mean, look, they went in 2015 from 948 million to 7.5 billion in free cash flow in 2024. And using my assumptions, they're going to go from 8.05 billion to 14.3 billion. So I don't think this is that exaggerated. I think this is a realistic assumption. And using these assumptions, we have a discounted cash flow price per share of $219.7. Next, moving on to historical multiples valuation and multiples valuation, we get an acceptable buy price of $246. I compared them to Taiwan Semiconductor Manufacturing and Micron Technology because they operate in the same industry. And also, I skipped the dividend discount model since their dividend is not high enough to or important enough for them to warrant a mention. Now, inputting the averages of all these three, we get an intrinsic value of $228.5 and applying, let's try 20% margin of safety. No, so it's only a 15% margin of safety. We get an acceptable buy price of $194. Now, what do I believe? Well, of course, Applied Materials operates in a cyclical business, as you all know. It is important to note that all semiconductor manufacturing is cyclical and they may or may not continue their growth rate. But in general, technology manages always to grow, and I believe that these valuations are fair, they are true, and I don't think they deserve a more than 15% margin of safety. I think it's okay. If you want more than 15%, of course, always do your own calculations, always use your own margin of safety, and always do your own due diligence. Due diligence is the key to value investing. The diligence, sorry, is the key to all investing, no matter what you're investing in, real estate, stocks, gold, whatever. Due diligence is the key. Now, I believe they're a great business trading at a great price, and also as we saw this from the start, they have great, insanely good balance sheet. They have great metrics in general. They're trading at a good valuation. I just think that they're a great company. I don't see any problem with it. I think it's a great company. They have great products. They've managed to grow continuously over the past decade, as we can see here, their free cash flow. Yeah, it's just a great business. Now, the next stock that has reported earnings is Unilever. Let me check for a second to remember their. Oh yes, UL Unilever. Um, Unilever, of course, I think you've heard of it. I mean, it's a bit of more of a boring business compared to the other. It's a British multinational, fast-moving consumer goods company, so it's not really that interesting. I think of, I don't know, soaps or what? Why isn't it loading? Sorry, 2023. So soaps and other things. It's not really that interesting of a business. Uh, yeah, it is not for many people since it's very low growth, but for value investors that love dividends, then yeah, they may be a buy. But let's see. First of all, the return on invested capital is 13.1%. Their return on equity is 46%. The return on tangible assets is 18%, so pretty good. And the current ratio is 0.76, which is mm, mediocre, should I say. The free cash flow yield is 7%. Now, what is of note here is that they're trading at an extremely similar valuation um, to applied materials, but they're much lower quality. So let me show you what I mean. First of all, let's input let me check their 2025. So it's $3.31. So their buy price according to Graham's device formula is $77. But let's go to the discounted cash flow. Now we can see that their free cash flow has grown. It is actually very similar to AMAT's free cash flow, but it is much less growth. You can see that they've gone from 3.6 billion to 7.9 billion. And if you remember correctly, this is much, much lower than applied materials. And they are trading at the same valuation. So see what I mean? I've already said this in previous videos. There are companies trading at similar valuations, but they're much different qualities. They have one of them is much better, one of them is much worse. This is why I always, always, always recommend to check for other opportunities on the market. There may be a company that is trading at a great price, but they're actually a company that may be trading a bit higher, but it's a much better stock to buy. Or there are two stocks which are trading at the same valuation, and one is much better buy than the other, but you're not willing to pay attention to the other because you've already thought out your investment and you think that the first company is a better investment because you do not want to waste time on your due diligence on a second company. And this is a great error. You must always, always, always do your own due diligence on the entirety of your portfolio and also on companies that are not yet in your portfolio. Be like Warren Buffett, have, I don't know, 100 stocks that you have done your due diligence on and you know what price they deserve, and when they reach that price they are a buy. So you should know a set of companies like the back of your hand, and when the time strikes midnight, the clock strikes midnight, you should buy them. But I'm getting a bit off topic, sorry. Let's see. So they've had the average growth rate of 11%. I don't think they're going to grow as much because their revenue is growing at 4%. And realistically speaking, the free cash flow is not going to grow that much above the revenue. So I'll just put 6.25% here. Perpetual growth rate of 2% I think is realistic, and discount rate of 8% is the standard, especially for stable big companies. So $58.4. Historical valuations. I'll just jump over to the dividend discount model. The dividend discount model, so if the free cash flow is going at what I said, 6.25%, I'll just put this at 6% because they're growing their dividend in line with their free cash flow, approximately speaking. And let's remove the multiples variation and let's add the dividend discount variation. And you can see that they're trading at a 15% margin of safety, actually more. They're trading at a 25. Yeah, they're trading at 27% margin of safety compared to intrinsic value. But again, we what is of note here is that they're only trading at a 10% higher margin of safety compared to applied materials. But applied materials will give you a much better return in the future. And to add to that, I'm not sure. Of course, this is purely speculative, but I'm not sure that they're going to go for another decade at 6.25%. Uh, I mean, if they're growing now at 4% revenue, actually, I think what I should do is lower this to 5%. Now that I think of it, it's much more realistic. And also, since we can see that in the past 3 years, their free cash flow has declined, and also 5% has declined, not that much from 8.2 to 7.9. But if we include inflation, it's actually gone from something like 10 billion in today's dollars to 8 billion. So we just put 5% growth rate and we'll adjust the dividend discount model to 4.5. And now we get a bit more realistic intrinsic value, and they're trading at 5% margin of safety. So as you've seen, only adjusting the numbers a little bit gives you a much more different intrinsic value. So this is why you always do a lot of diligence. You have to be sure of what their growth rate will be. You have to be sure of how their balance sheet will look like. If they do buybacks, with what money, with what interest did they acquire that capital? This is a great matter to all investors. Now, Unilever, as I've said, is a boring business. It's just that type of business that you buy when their stock price lowers enough. But yeah, I think Applied Materials is a much better buy in this case. Of course, do your own due diligence. I always insist on that. Yeah, and I think we can end the video here. Do not forget to check out my affiliate for today, Ticker Data. Ticker Data is the tool that I use today. So they have these templates with real-time financial data. You just plug in any ticker symbol and it just appears. Also, do not forget to check out my investing blog from the link in the description below, where I feature in-depth analysis. And yeah, this has been it for today. I hope to see you in the next video. Bye.